You're on the phone with the seller. They inherited a house. They won $175,000. They think it's worth $300,000. On paper, that's $100,000 a room. Then you start checking. You verify the repairs. You pull the real comps. You add in financing and holding costs. Due diligence turns up problems nobody mentioned on that first call. You test 4 different exits. By the end, your deal in your head and the deal on paper don't look anything alike. That's what real deal analysis looks like. Not one formula, not one impressive spread between 2 numbers. A series of decisions, and every new piece of information changes what you should do next. In this video, we're taking one property from the first phone call to the final decision, so you can see exactly what changed and why. If you're new to this, here's the habit that matters more than any formula. Stop asking, is this a deal? Start asking, what do I actually know right now and what still needs to be verified? Early on, almost everything is a guess. The seller's value is a guess, their repair number is a guess, your repair number is probably a guess too. The timeline, the financing, the exit price, none of it's been tested yet. Your job is to reduce that uncertainty one step at a time. Here's the property, 1,450 square foot, 3-bed, 1 bath, no garage, old kitchen with warm floors, a roof that's seen better days, a heating system nobody's touched in a year. A seller inherited from a family member. They live hours away. The house is set empty for almost a year and they're done paying taxes and insurance on a place that they've never wanted. They believe it's worth $300,000 and they're asking $175,000. They think repairs are about $15,000 and that's the starting point. None of those 3 numbers survive what comes next. I've run this process dozens of times and it plays out the same way almost every time. The first phone call always sounds better than the actual deal. So before we touch a spreadsheet, we start where every deal actually starts, with the seller, not the property. Phase 1, is this lead worth pursuing? We ask, why now? The house came from a family member. The seller doesn't live nearby. It's sat vacant for months. And they want it resolved in about 60 days. That's a real reason to sell, a real timeline, and a seller who values convenience over top dollar. It's not a deal yet. It's a lead worth chasing. Phase 2 is ask before you calculate. When we asked about the property, the roof's about 20 years old. Heating worked a few years back, untested since. 1 known bathroom leak and a $300,000 number came from a renovated house nearby that sold for close to that. One more question matters more than any of those. Who else has to sign off? 2 siblings do. That's 3 decision makers, not 1. The numbers can work perfectly and the deal can still die in a family group chat. Because the deal is never just the property, it's the property, the people, the numbers, and the paperwork. Phase 3, the property visit. We walk it ourselves. The seller's $15,000 doesn't survive 5 minutes inside the house. Warm flooring, tired paint, a dated kitchen, water damage in the bathroom, broken windows, a heating system that doesn't run, a roof that may need to go, wiring that looks suspect. We're not building a precise number yet. We're deciding light, moderate, or major work. And this is major. The working range jumps from 15 to somewhere between 50 and 70,000. Phase 4 is to verify the value. Next, the seller's comp. It's real, but it's bigger. It has an extra bedroom, 2 bathrooms, a garage, a nicer renovation. Not the same house. We pull better comps, 276, 269, 282. Similar properties actually renovated. That went to a realistic value around $275, not $300,000. $25,000 gone before we spent dollars on repairs. Phase 5, verify the repairs. Contractors walk the house, the roof, the HVAC, kitchen, bathroom, flooring, paint, windows, exterior, electrical, plumbing, permits, disposal. The number goes back around $60,000. The seller said 15. That's a $45,000 gap. And now we're looking at a completely different project than the one described on that first call. Phase 6, calculate the maximum price. Now we work backward. Value is $275,000, repairs $60,000, buying cost $5,000, holding is $8,500, financing $10,000, selling $22,000, contingencies $8,000, required profit $30,000. Run the math and the most we can pay is about $131.5. The seller wants $175. We're $43,500 apart. Their price might be fair for somebody else. It doesn't work for this project. Phase 7 is negotiation. We don't tell the seller the house is only worth $131.5. That's not what that number means. We explain that our price comes from the renovation costs, the carrying costs, selling costs, when the margin, the project needs to make sense. They talk to the siblings and they come back at 130, and it's workable. But an accepted offer isn't the finish line. That's where due diligence starts. And that's phase 8. Due diligence changes the deal. A deeper inspection, deeper problems, full roof replacement, worse water damage, a dead electrical panel, corroded plumbing, 2 extra months of timeline, repairs jump from 60 to 78,000. The new comps put the completed value closer to 268. Time to rerun those numbers. Phase 9 is revised numbers. The value to 68, repairs 78, costs and contingency it add up to roughly 60,000 more. The required profit, still 30,000. That supports a purchase price of around 101, not the 130 we already agreed to. We haven't lost 29,000. We found out our assumptions were wrong before we closed, and that's the entire point of due diligence. Phase 10 is to renegotiate or walk. Back to the seller. This time with contractor bids, inspection findings, updated comps to back it up. They won't take 101. They'll go to 112. Now you stretch, walk, or find another way out. This is exactly where inexperienced investors focus only on getting the deal closed. Closing isn't the goal. The sound decision is the goal. So instead of forcing the renovation plan, we test the exits. Phase 11 through 13. Testing them. Full renovation and resale at 112. Still pencils barely the thinner margin, longer timeline, more construction risk, renting it out at roughly $1,900 a month. Technically cash flows, but after taxes, insurance, vacancy, and reserves, there's not much room to absorb the bad month. Or skip the full renovation, fix the safety issues, clean it up, sell to another investor for around $155. The total cost is near $129,000. The margin's near $26,000. Less profit in the full renovation, but less capital, time, and risk. Phase 14, the final decision. 4 options on the table: full renovation, higher potential profit, higher risk, a rental, positive cash flow, thin cushion, limited work and resale, slightly less profit for meaningfully less exposure, or cash and keep the capital available for the next opportunity. Based on what we know, the limited work resale looks like the strongest combination of return time and risk, but only if that $155,000 exit price actually holds up under scrutiny. If it doesn't, passing is still a good outcome. Go back to that first call. The value, $300,000, repairs, $15,000, asking price, $175,000. A beginner does that math and sees $110,000 a room. What we actually found was a value closer to $68,000, with repairs at $78,000, plus financing, building, selling costs that never came up in that first conversation, plus a required profit margin and judged to months. A real deal looked nothing like the first 3 numbers. Now, if you want to see how expensive real estate programs strip out exactly this kind of uncertainty to make their case studies look clean, grab the Seminar Survival Guide in the link in the description below. Now, here's the insider breakdown. Here's what they show you. You buy it for $175, put $15 into it, sell it for $300. $110,000 story that fits one side. What they leave out, what that repair number came from, whether the comp was actually comparable, and every dollar of financing, holding, and selling costs between the purchase and the sale. What you actually need to know. Any spread that big is a hypothesis, not a deal. Ask where every number came from before you believe any of them. Here's a filter you can use on any deal somebody shows you, finished or in progress. Ask them to walk it backwards. What did they think repairs would cost, and what did repairs actually cost? What were the holding costs? How was it financed? What did it actually sell for or rent for? What got left out of the headline number? What happens if the sale price comes in 5% lower? A finished success story hides all the uncertainty that existed when the decision actually got made. Studying the decision teaches you more than studying the result ever will. A real estate deal isn't one calculation, it's a sequence of them. At every stage, what do I know? What am I assuming? What changed? And does this still meet my standard? The point of analysis isn't to talk yourself into buying. It's to make it easier to say no when the evidence says no. So next time a deal crosses your desk, don't Get impressed by the spread between the seller's number and some future value. Slow down. Verify one assumption at a time. The investor who walks away from a bad deal is the one with capital left for the good one. That's the full arc. First call to final decision. The harder question is what happens after you close. Cash flow, reserves, and the numbers that tell you whether the property's actually performing. And that's next. But again, grab the free seminar survival guide using the link in the description below. And if you want the actual spreadsheet and stage-by-stage checklist we use to run these exact numbers, that's inside the vault. And as always, subscribe to Seminar Insider for practical real estate education without the high-ticket seminar pressure.